Hey, good morning, everyone. Marty Missouri here, 17th of September 2019, Tuesday. Market update for you this morning. The S&P daily futures chart in front of you. As you'll recall, yesterday we broke down, we opened lower, quite a bit lower after the attack on Saudi oil production over the weekend. It could have been worse, in my view, given the events and the impact on oil prices yesterday and so on. But the market did battle back, still closed lower, but ultimately from the open had a pretty good day, all things considered. So now you can see this morning we've got this red candle going up here. I suggested it's wouldn't surprise me to see us come back up here. Typically you would test this trend line. My guess is that there's a good chance, although we've got the Fed meeting tomorrow, so that could be the kind of thing that blows us right up through here, depending, of course, on what's decided and maybe more importantly what's said. But under normal circumstances, you'd expect with this kind of breakdown, you come back, you retest it, and then likely, given my view of the world right now, you come down and begin testing some of these lower lows that we were looking at. And I suspect at some point in the not too distant future, we'll be having those conversations again here at lower levels. Now, I did say in yesterday's written blog that my view is kind of flipped in terms of what I expect this week. And it's not being confirmed this morning, by the way. My view was better than 50-50 odds that the Fed disappoints. After the weekend, I think that's a shock. And I think that that would probably have the Fed sounding a bit softer in its tone. The market could rally on that. I'll add one more thing, and this is way under the radar for most people. In the overnight funding market, and this is where banks take care of each other in terms of required reserves. Through the daily activities, if banks run short, they'll borrow from one another reserves to make sure that they meet the minimum requirements. Last few nights, we've had some kind of freaky stuff go on in there. We had really big, unusually big spikes in the rates that banks charge each other, and that essentially is the Fed funds rate. And these spikes, again, were notably high, meaning these rates spiked way above what the target rate is. Now, there's a whole bunch of speculation as to what's going on there and why that happened. At the end of the day, what it has to be is a very unusual lack of liquidity relative to demand for that funding. Whether or not the Fed needs to accommodate for that, well, they do, but whether or not they do anything or say anything publicly and start talking about the potential for quantitative easing, if they did do that, I think the market would rally aggressively. Having said that, I don't know how much upside is here. I have a sense that it's not a great deal of upside given these levels and given the real longer term issues that are out there. But if indeed the Fed even hinted at quantitative easing, which would be a way to fix potentially some liquidity issue in the banking system, the markets would like that. What it would say about the funding market and the reserve levels in the banking system and the state of the economy would be very concerning and would not be ultimately a good fundamental signal. So anyway, a lot of stuff going on. On balance, I expect the Fed to be dovish. I expect the market to like that. And I expect I could very well be wrong. Maybe these aren't issues that are concerning the Fed. Maybe they're keeping their eye on the ball, looking at data, looking at inflation, and maybe indeed it'll be what I expected coming in, and that is a relatively hawkish Fed in a market that's not going to like it. Right now, looking at futures, you expect maybe the market's already making that decision. So it'll be interesting to see. But I want to run you quickly through one more thing that has to do with Fed cuts and the stock market, and then I'll let you go. Here, you're looking at the last 6 recessions. The green line is the Fed funds rate. The purple line is the stock market. So I'm going to go back here and I'm going to take us right into that 1973-74 recession. And I want to show you this relationship here as we get late in the cycle between interest rates, or the Fed funds rate, and the stock market. There's this old saying on Wall Street, don't fight the Fed. Again, you've seen over and over again what happens when the Fed cuts rates. The stock market tends to like it. So here we are leading into that 70s recession. Notice we have, the Fed come in here and cut rates after raising for a while. Market responds as you'd expect. And these squares here are 1 month. So that's a month. That would be 2 months, month and 2/3 going in. And then you can see shortly thereafter, market came down. Fed stopped cutting. Interestingly, the Fed was raising rates and inflation going on. Ironically, amid an ongoing recession. Back in the early 80s, we had these back-to-back recessions, so let's just combine those two and look at them together. Here's the Fed cutting rates. Here's the market reacting aggressively to the upside, and here's a recession happening just almost immediately thereafter, and of course, there's the market tanking. Here's the Fed cutting rates during the recession. Makes sense. Here's the market coming out of it. Market always bottoms before the recession ends, it seems like. Here's the Fed cutting rate. Obviously, we're seeing something negative happening in the economy. The Fed's trying to get in front of it. Here we are seeing inflation. Here, the Fed no doubt reacting to inflation. That's what was happening here. Those of you who are old enough may recall the late 70s, early 80s inflation. We had 18, 19, 20% interest rates, mortgage rates in the high teens, and so on. So a really weird period, but just, again, just evidence that you shouldn't take as gospel the notion that every time the Fed cuts interest rates, that it spells very good things for the stock market over an extended period of time. Okay, heading into the 2001 recession, the tech bubble burst, and that was certainly a hellacious bear market for stocks. So here you have the Fed realizing it's coming, cutting interest rates, nice rally in stocks, but it was too late. We got late in the cycle. Fed cuts could not save the economy, nor could they save the stock market. We had an ugly 3-year bear market is what this ultimately morphed into. Then leading into the biggest recession since the Great Depression, the mortgage-backed securities and the real estate bubble bursting. Here we have the Fed cutting interest rates pretty aggressively leading into that. Aggressive rally in stocks right there, peaking at all-time highs, then 2 months before rolling over again into the worst recession since the Great Depression again. Fed interest rate cut, market rally, late cycle, a lot of other stuff under the surface, the kind of data that I've been presenting to you and over again the last few months. And then again, Fed cutting interest rates into it, markets often getting a knee-jerk response, but certainly not enough to save it. So again, we should be very skeptical of these Wall Street adages that suggest that every time the Fed cuts rates, it's a beautiful thing for the market, at least for an extended period of time, because that's clearly, as I'm showing you here, that's not always the case. And then you fast forward to today, we are not in recession right now. We have issues that concern me that I continue to talk about. The risk is heightened notably from where we were a year ago. So here's the Fed cutting interest rates, July meeting. Here's the market rallying into that. Here's the market rallying after. Here's the market coming back. Here's the market rallying again, I think in anticipation of what we're going to get this Wednesday, and clearly it'll be another 1/4 point cut in interest rates. We'll see how the market reacts to that. But again, folks, as I've been showing you, some of this other data, which is a lot like the data leading into past recessions, and therefore clients, this should give you a feel as to why we are not really jumping on board with what I see could be a move to new all-time highs. Thank you as always for watching and listening, and talk to you again soon. Bye-bye.